Let's work some exercises in Chapter 5 then. As I said before, if you're really interested in this topic, there's so many ways you can go. There's so many different classes you can take in it. If you're interested in law enforcement, this is a very lucrative area. It's an area that you will never have difficulty finding work because it's so important and so necessary. FBI hires a ton of people, and probably one of the biggest employers of accountants in the nation is the FBI in this area, in fraud and forensics. This exercise then, we are to identify internal control principles. And the internal control principles were listed on one of our PowerPoint slides. So I'm going to go through these. One office employee places all the merchandise orders. This is an example of establishing responsibilities. And one of the key things about establishing responsibilities is if you have these responsibilities in place and you make sure the employees are only doing what they're responsible for, then you can determine which employees are not doing their jobs well, where the errors are coming from. And it also helps you with something else that's related to this, which is segregation of duties. Let's move on to the next one. Goods are received only by warehouse employees. Well, this goods receiving business is a custody. So custody needs to be separated from record keeping and authorization. So that's an example of segregation of duties. The next one. The warehouse is locked and activities electronically monitored. Well, you might think that this is custody or safeguarding of assets. It could also be called restricted access. Merchandise orders are recorded on a purchase order form. As I said before, there's a class that you can take in AIS which will learn all kinds of documents and the purposes of documents, so I'm not going to spend a lot of time on it, other than that you understand that documents are important. So they're talking about documents in this, and the particular document is the purchase order. Receiving reports are another document, and the document is going to be completed, so that's a procedure related to documents. And then billing and receiving reports and comparing things. This is an independent verification. One of the important independent verifications a company can have is the sending bills out to their customers. If the customers disagree, they're going to call you, they're going to tell you it's wrong, and that's a form of independent check or verification. On September 30th, there's an involving a petty cash fund. $100 is replenished. At the time, the box contained $18 cash, and it contained receipts for $40, $12, and $30. Prepare the journal entry to replenish the fund. Well, one of the first things we need to do is we need to find out if we have enough receipts to equal the amount that needs to be put in. So you have 18 and 12, that's 30. And then you have another 30 for the office supplies, that's 60. And then you have receipts for taxis of 40. So our receipt total, I believe, including the cash, is going to be 100. Okay? The amount that we're going to put back in it is going to be, though, just the amount of receipts. And the receipts is 40, the receipts is 12, and the receipts is 30. Office supplies are called supply expense. Delivery charges are called delivery expense. And the taxi fares are called travel expenses. So, if we had $18 in the box, and we have receipts of 82, as I just did a moment ago, those totals added up to the 100. So the drawer is neither over nor short. The total amount of cash which we need to give this petty cashier in the form of a cash check is going to be for $82, which is the same amount as the receipts. So this Hector is doing a wonderful job as a petty cashier. There's no overage, there's no shortage, they have all the receipts in order, And so the accounting department is going to get the receipts, they're going to process it, and there's going to be a journal entry done, a cash check for $82 made out to Hector. Now this is a bank reconciliation. One thing I would suggest with this is that you may want to print out the PowerPoints and so that we can work through the bank reconciliation and you can look at this slide at the same time. Notice here that the bank statement balance is $6,070 and our ledger balance is $6,400. A bank reconciliation is going to help us determine what the differences are in between those numbers. We know part of the difference is going to be coming from the bank because the bank is not going to process all the checks that we have written and the bank may not process all the deposits. And we can read this discussion down here, and it says a comparison of the check written with the checks that have cleared the bank shows outstanding checks of $700. So the bank has not processed $700 of our checks. This is a timing difference which shows up on the bank side. Some of the checks that cleared in June were written prior to June. That's okay. No deposits in transit were reported in May, but a deposit in transit is in transit at the end of June. So we go up here and we notice that there is a deposit here in the bank statement in June for $18,000 during June. But when we go down here and we look at our ledger account for June, we see $19,000. So this doesn't quite agree, does it? We have a difference. You have a difference in the amount of deposits. And they're telling us down here that the issue is because there is a deposit in transit at the end of June that the bank has not yet recorded. So we're going to have timing issues. So again, left side is usually the bank side, right side is our ledger balance, our ledger account side, our books, the company's books. So this is our balance, the ending balance we show in our ledger. This is the ending balance in our bank statement that they mail to us. We have $1,000 in transit, which has been recorded on our company records, has not been recorded yet at the bank. We have $700. This is an amount they told us already there was going to be in outstanding checks. Here is the calculation of the $1,000. One of these is the amount which showed up on the records for the company as deposits, and the other is the amount which showed up in the bank statement for those deposits for the month. There is a $1,000 difference. The $1,000 has been identified as the deposit that the bank has yet to record as a plus into our account. If we add it back into their records and we subtract out the outstanding checks, we will come back to a number. And then when we go to our accounting records and look at it, we notice that we really didn't have much problems. The only difference we could come up with was that we have not yet recorded our service charge, which should reduce our cash balance. If we do our journal entry, and this is only going to require one journal entry because there's one item on this side, the one item is going to be for $30. When we do the journal entry, our bank account, our adjusted ledger account of the bank should be $63.70. So here, give any journal entries and what is the balance? We just discussed that. And then we're going to talk also about a petty cash that needs to be handled. So the $30 is going to be reducing our bank account, our ledger account that is related to that bank account for $30, calling it office expenses. I also said you could call it miscellaneous expenses. This 6370 is the balance which is across the bottom of the bank reconciliation. It's the number which shows up as the adjusted bank balance. It shows up as the adjusted book balance. In addition, we have a $300 of petty cash on account. How does this show up? Well, the petty cash that is on hand needs to be included as a cash. It is another example of cash. Now we have some petty cash transactions. We established the petty cash fund January 1st, so we're going to cut a check and we're going to give the check to the individual who's the petty cashier. Then we're going to have transactions coming out of the petty cash. One of the first steps we need to do, like we did before, is we need to add up all of these transactions on January 2nd, 7th, and 10th and see what they add up to. Those plus the amount that's missing, those should be equal to the amount that is missing from the petty cash box. In this case, we start out with 100 and we end up with 10, so we should have 90. What we want to see is we want to see all these for which we have receipts equaling 90. So they're asking us for a journal entry. The first journal entry is going to establish it. We're going to cut a check. The check is made out to the petty cashier, whoever that's going to be. They didn't tell us this time. $100. Now, when we have the receipts, when we have these amounts going out, we don't record journal entries as they're going out. Instead, we wait to the end, and we are going to go in and we're going to count up these things and see if they add up to 90, which we said was the difference between the beginning cash of 100 and the ending cash of 10. And lo and behold, they did add up to 90. So there's no overage, there's no shortage, and we're going to record these in their proper categories.